Good afternoon. Thank you for joining us today for our webinar, Navigating the New 199A Tax Guidance, How It Impacts You. I'm Bob Sharon, Partner and Tax Practice Leader for Friedman. I have more than 30 years of public accounting experience working with high net worth individuals, family groups, and a range of businesses spanning multiple industries. My primary focus is enabling Friedman's tax department to efficiently assist clientele with tax planning and compliance needs to sustain and increase their assets. Presenting today is Michael J. Greenwald, Partner and Corporate and Business Tax Practice Leader. Michael has over 30 years of experience in public accounting. He has served clients in a variety of businesses, including financial services, technology and media, manufacturing, wholesale distribution, private equity, real estate, construction, and professional services. Michael is also the chair of the Partnership Taxation Technical Resource Panel of the American Institute of Certified Public Accountants. Also presenting is Stephen Bocaius, a partner at Friedman LLP with more than 20 years of experience. He has an extensive background providing tax consulting and compliance services to an array of real estate and asset management clients, including REITs, real estate partnerships, private equity funds, hedge funds, and investment advisors. Friedman is a leading provider of accounting, tax, and business consulting needs of public and private companies since 1924. We are consistently ranked among the top 50 accounting firms nationally and have ranked among the best places to work throughout the accounting industry in all regions where we operate. Friedman's Tax Services Group is dedicated to helping clients maximize their tax position and uncover opportunities in light of sweeping tax changes resulting from the Tax Cuts and Jobs Act. We've had our finger on the pulse of tax reform since before President Trump's election, delivering insights through a host of white papers, webinars, and live events, and our latest video series, Tax Talks Unraveling Reform, to keep you apprised of critical tax changes that can impact you. We're pleased to bring you programs such as today's 199A webinar, and we'll continue to share insights as new guidance is released to help you navigate the complex and evolving tax landscape. Also, keep in mind on October 10th, our state and local tax experts will be presenting a separate webinar on new sales tax rules in the wake of the Wayfair decision and the far-reaching implications for out-of-state sellers, particularly those with online sales. The goal of today's program is to help you make sense of the recently released, highly anticipated proposed regulations for the Section 199A deduction and how these regulations may impact you. Our presenters will provide an overview of Section 199A and will help you understand who qualifies as well as the mechanics of the deduction. We will also address vital questions that remain unanswered at this time and planning considerations. At the conclusion of the webinar, we'll attend to those questions from our listeners. You can submit your questions and communicate with us throughout the course of the webinar using the Q&A feature on the lower portion of your screen. We would also be delighted to schedule time to speak with you on a one-on-one basis to better guide you on your particular situation. And at this time, I'm pleased to turn the presentation over to my colleague, Michael Greenwald, who will kick off the program with an overview of Section 199A. Michael?
Thanks, Bob. So 199 Cap A, as we call it, entered the tax code back in December of 2017 with the major tax reform. And like a lot of that tax reform, it was not perfectly well spelled out how the section was supposed to operate. So we've been waiting for guidance from the IRS, and we finally got that guidance not too long ago. And now we've been going through that. And while it's helpful, it's still not complete. And we'll get to some of that in a little bit. But for starters, what is 199 Cap A? It's alternately referred to as the pass-through deduction, the 20% deduction. Some people would like you to think it's the small business deduction. But essentially, it's a deduction from taxable income of up to 20% of the qualified business income from certain trades or businesses. The provision is already in effect. It's already available for 2018. Right now, it's scheduled to sunset in 2025. And as I said, the deduction can be up to 20% of a pass-through business owner's qualified business income. You're going to hear that referred to throughout this webinar as QBI. So when you hear QBI, that's the income from a pass-through entity. Now, this deduction is subject to certain restrictions that apply to those with higher income levels, and there's finally another limitation based on the owner's taxable income. So who qualifies for this deduction? Well, the term that the IRS uses is pass-through entities, but that really represents a large swath of the tax-paying community. It includes sole proprietorships. It includes single-member LLCs that are treated as sole proprietorships for tax purposes. It includes S corporations, partnerships, LLCs. Underlying all that, it has to be a trade or business, and we'll get into the definition of trade or business in a little bit as well. The deduction, though, ultimately resides at the level of the individual taxpayer. And for these purposes, individual also includes trusts and estates, which gives rise to some planning opportunities, but also some further complications. Now, I keep talking about trades or businesses. In order to define what types of activities are eligible for this deduction, the IRS, in writing the regulations, decided to adopt a definition that they believe comes from another code section. Code section 162 talks about the ability to deduct expenses related to a trade or business. But unfortunately, it doesn't include a definition of trade or business. And in fact, you won't find that definition anywhere in the Internal Revenue Code or regulations. It comes from a whole series of court cases. The courts, including the Supreme Court, have said that to be a trade or business, it has to be an activity that's regularly and continuously engaged in for the pursuit of profit. But that's really not detailed enough. So we're hoping that when the final regulations come out, the IRS will have responded to the many comments it's receiving as to the definition of trade or business, and perhaps making that more clear for purposes of 199 Cap A. So those are the basics. Now, to get into more detail, I'm going to turn it over to Steve, who's going to talk about the mechanics of the deduction. In other words, how it works in real life.
Thanks, Mike. Mechanically, the implementation of the rules can get complex. Ideally, the 199A deduction is equal to 20% of QBI, but this can be limited by the business owner's level of taxable income and the characterization of the QBI as a specified service, trade, or business. And we'll delve into that definition later in the presentation, but briefly, a specified service, trade, or business is a service business in things like accounting, law, healthcare, and consulting. For married taxpayers with taxable income in excess of $415,000, the QBI deduction in a non-specified service, trade, or business is limited to the greater of A, 50% of the W-2 wages of the QBI, or B, 25% of the W-2 wages plus 2.5% of the unadjusted basis of depreciable property immediately after acquisition, or in other words, the original cost. This limitation, this wage limitation, this property limitation is phased in from $315,000 to $415,000 of taxable income for married taxpayers, and from $157,500 to $207,500 of taxable income for single and other taxpayers. And it should be noted that other taxpayers include trusts. For specified service, trade, or business, this entire deduction is phased out from $315,000 to $415,000 of taxable income for married taxpayers, and from $157,500 to $207,500 for single taxpayers. So if someone is a partner in a law firm and has $500,000 of taxable income, they're not entitled to the 199A deduction. In contrast, if they're a partner in a law firm and they only have $200,000 of taxable income, they're entitled to the 199A deduction. Once the tentative 199A deduction is computed, it's subject to a global limitation, and that's 20% of the taxpayer's taxable income less net capital gains. So let's assume that a taxpayer, after running through all the limitations, comes up with a 199A deduction of $150,000. Let's assume that their overall 1040 taxable income is $1 million, of which $800,000 of that is a net long-term capital gain. Well, what's their limitation? Is it $150,000, the tentative deduction, or is there some other limitation? You would take $1 million of their taxable income less the $800,000 of their net long-term capital gain, which is $200,000 times 20%, which is $40,000. So even though, based on their QBI activity and limitations, they thought that they were getting $150,000 Section 199A deduction, in reality, they're only going to get a $40,000 199A deduction. In terms of the wage limitations, wages can be allocated across multiple related trades or businesses. So if there's a management company, and let's assume that management company has all the employees, all the W-2 wages, and manages several real estate partnerships. Say it manages 10 real estate partnerships. Well, those wages can be allocated to the different partnerships. That's important in terms of the allocation, because otherwise those activities would be deemed to have no wages. The proposed regs also indicated that wages paid by a third party on behalf of a trade or business can be attributed to that trade or business. A lot of management companies, a lot of businesses use a PEO, a professional employer organization, and those wages could be attributed back to the activity. In terms of depreciable property, one of the limitations is 2.5% of the original cost of depreciable property. Well, what does that mean? Qualified property is defined as depreciable property that's owned by the qualified business as of the end of the tax year. So if the qualified property is disposed of in the middle of the year, it doesn't count. If it's disposed of on December 30th, it doesn't count. The depreciable property has to be used by the business for the production of QBI, and the depreciable property cannot have reached the end of its depreciable period. That said, the depreciable period is deemed to be at least 10 years. So if there's 5-year property, 7-year property, even though it's fully depreciated after 5 years, after 7 years, it's still deemed to be within its depreciable life for 10 years, which is obviously beneficial in computing the deduction. Yeah.
Steve, I can see that acquiring UBIA property might be beneficial at the end of the year to supercharge the deduction. Can a company that's part of a group of related companies acquire property from a related party?
Yes, absolutely. There's nothing that would prevent that.
But I'm assuming that this has to be able to demonstrate that it uses that property in its trade or business.
Right. The property couldn't just be purchased and not used in the trade or business. It would have to be used in the production of the QBI. And it couldn't be disposed of shortly thereafter. It would have to be purchased, used in the QBI, and retained. Another thing to point out that in defining unadjusted costs, the regulations exclude 754 adjustments. So typically on the sale of a partnership interest, there's a basis step up. That's not counted. On a 1031 exchange, the original cost of the property is not counted. It's the net tax basis at the time of the 1031 exchange. So that's a limitation as well. At the individual level, taxpayers have the ability to aggregate several trades or businesses for purposes of calculating QBI and for purposes of combining all the wages, all the depreciable property, and determining the limitation. This can be very beneficial. So someone may ask, well, fine, why don't I just aggregate all of my trades or businesses? You can't. Trades or businesses can only be aggregated under the following conditions. Number one, each trade or business itself has to constitute a trade or business. Secondly, the same person or group of people have to own, directly or indirectly, 50% or more of each trade or business. The ownership has to be held for a majority of the taxable year, and all the items attributable to each trade or business have to be reported in the same taxable year. None of the trades or businesses can be specified service trades or businesses. Service businesses cannot be aggregated with non-service businesses and cannot be aggregated together. And the trade or business has to satisfy at least two of the following factors. They have to provide products and services that are the same or customarily offered together, like a gas station and a car wash. The trades or businesses have to share facilities or significant centralized business elements such as personnel, accounting, legal, backroom functions, manufacturing, human resources, information technology. And the businesses need to be operated in coordination with or reliance on other businesses in the aggregated group. So to the question, why don't I just aggregate everything so I can maximize my 199A deduction and combine my W-2 wages, combine my depreciable property? You can't unless all of these conditions are satisfied.
So Steve, if I have a real estate business and I have multiple properties and I've got a centralized property management company, and so that management company provides the property management and the facilities maintenance and sends out the rent bills every month and all that, I clearly meet the second of those 2 out of 3 factors that I have to reach. But how do I demonstrate that the businesses are operated in coordination with other businesses in the aggregated group? Do they all have to be operated in coordination, or is it sort of like a spoke and hub thing where I've got my property management company in the middle that works for each of my real estate properties, and therefore they're all working with that company, so they can each be aggregated with that company and therefore all be aggregated together? I'm making this too confusing because I'm confused.
I think a single management company that's managing several rental properties, I think one can make an argument that those could be aggregated, but I don't think it's entirely clear.
Well, then I'm not confused for no reason at all.
What's the benefit to aggregating? Very simple example. Let's assume that an individual is invested into qualified businesses. Let's assume one generates a large amount of QBI but has no wages and no depreciable property, and the individual owner is in excess of $415,000 in taxable income. Well, that individual owner from that activity would be entitled to no 199A deduction. Let's assume there's a related business also generating QBI, which has very little QBI, but has a large amount of wages and has a large amount of depreciable property. Well, by aggregating those businesses together, the taxpayer can maximize 199A deduction. So there's definitely an advantage to aggregating in terms of these limitations, in terms of combining wages, in terms of combining your depreciable base for the 2.5%. Specified service trades or businesses, that designation is extremely important because beyond $415,000 of taxable income, there is no 199A deduction for anything characterized as a specified service trade or business. For single individuals and other taxpayers, it's completely phased out at $207,500 of taxable income. Now, interestingly enough, architects and engineering businesses, which are clearly service businesses, are not designated specified service trades or businesses, so those owners are entitled to the 199A deduction. There was some thought that there would be a planning technique for taking a specified service trade or business, such as an accounting firm or law firm, and maybe separating out the billing function so that at least that function would qualify for the 199A deduction. It would not be a specified service trade or business. The proposed regs more or less shoot that down. So what are examples of designated specified service trades or businesses? Businesses in the fields of health, including pharmacists. A pharmacist doesn't see a patient, but a pharmacy is considered a specified service trade or business.
Steve or Mike, do you think a radiologist would come under the umbrella of health?
I think that is an interesting question. I've been thinking about that one in particular because there are different types of radiologists. Obviously, if I'm a radiologist who provides radiation therapy to cancer patients, then I'm actually dealing with a patient. But if I'm a radiologist who merely reads x-rays or MRIs and then provides reports to the actual doctor, so in other words, a consulting radiologist, well, that wouldn't meet the test of a professional who provides medical services directly to a patient, which is the way they defined it in the regulations. So for me, I would think that consulting radiologists would be well advised to never actually look at the patient, never actually talk to the patient, never actually see the patient, just write up their report and send it to the requesting physician or institution, and then they might qualify for the 20% deduction.
Other designated specified service businesses include law, accounting, actuarial science, consulting, financial brokerage, investing or investment management.
Steve, does that include a financial planner?
I would argue yes, definitely. Real estate agents, though, are not considered to be in a specified service trade or business. So if somebody is an agent for selling houses, residential or commercial, it's not a specified service trade or business. And assuming everything else works, they'd be entitled to the 199A deduction. That's a key point. Traders are specified, performing arts are specified, athletes are specified.
Suppose I'm a bank. Does that count? If I'm an S corp bank, do I get the 20% deduction?
I think you would. Not entirely clear, but I think you would.
Finding a new business.
Another definition in the law that was passed last November is that a specified service trade or business could be any trade or business where the principal asset was the reputation or skill or one or more of its employees. That was a very open-ended definition, and there was concern that a lot of businesses that really weren't specified service businesses would get pulled in. For example, what if I was a run-of-the-mill restaurant, but I happen to have a very famous chef who's on TV all the time? Some were concerned that based on this definition, people are going to that restaurant because of the chef, his reputation or skill, that would be specified. Well, the proposed regs define that very narrowly, and under the proposed regs, if I owned a restaurant, which is not a specified service business, and had a famous chef, it would not be considered an SSTB. So how do the proposed regulations define that? They're defined as a business in which a person receives
compensation for endorsing products or services. If somebody is endorsing products, that's considered specified. If someone is receiving compensation for the use of his image, likeness, name, signature, voice, trademark, or anything else, that's considered specified. If someone is receiving compensation for appearing at an event or appearing on radio or TV, that's considered specified. So unless you're endorsing a product, unless someone is using your image, unless you're appearing at an event, it's not considered a specified service business.
So to go back to your restaurant and chef example for the moment, assume for the moment that the restaurant employs the chef, and the chef is being paid because they're using his name and his likeness and all that in the advertising. The restaurant's fine. It's not going to be disqualified as an SSTB. But the chef's income.
The chef's income, anything he got for endorsements, for using his name, his likeness, that would be considered an SSTB.
So he wouldn't get the deduction, but the restaurant still would get the deduction.
That's correct.
I think that's an important distinction because that was one of the things that we were worried about was that his personality, his personal reputation and name and skill would somehow taint the income of the restaurant merely because they employed him.
There's also a de minimis rule in regards to specified service businesses. What if a business isn't really in a specified service, but it has a small amount of activity that is? What if someone is running a small, doing accounting for third parties, but it's a very small piece of the business, and otherwise they wouldn't be a specified service business. There's a de minimis rule in the proposed reg. If the business has gross receipts of $25 million or less, as long as less than 10% of their gross income is from SSTB activities, none of the business is tainted. If a business has gross receipts in excess of $25 million, as long as less than 5% of their gross receipts are from SSTB activities, none of the business is tainted. There was concern that if I was not really an SSTB, but I had a certain amount of SSTB activities, it would taint the entire business. That clearly isn't the case as long as you're under those de minimis thresholds.
If you're over those de minimis thresholds, can you treat those as two separate activities and therefore two separate trades or businesses, or does the fact that they exist under one umbrella taint everything?
If you attempt to separate those trades or businesses, but there's common ownership, the separated activity generates most of its revenue from the other activity, it could be an issue.
But if it doesn't, if it just happens to be two separate things, suppose we'll go back to your pharmacy example for a moment. Let's say I've got a pharmacy that does $10 million a year in business, and only $1 million of that is from filling prescriptions, and the rest is from selling automotive products and greeting cards and gift cards and things like that. I'll clearly fall within this de minimis exception. But if 1 year the cost of drugs happens to go up and my gross receipts from the pharmacy are over 10%, but the pharmacy business is clearly unrelated to all the rest of the act, can I just treat those as two separate activities?
Yes, you could.
And suppose I have a different business, I have a computer business, and I sell you computers, but I also sell you consulting on how to use the computers. Consulting's an SSTV, but I don't charge you separately for that. It's all built into the cost of the computer. Is that now an SSTV, or am I okay?
I think you would be okay there. So mechanically, what happens if there's an overall loss? If after combining all the QBI activities, there's an overall loss, the 199A deduction for the year is 0. That QBI loss then carries over to subsequent years and is treated as a negative QBI from a separate trader business in the following year. So for example, let's assume in year 1, there's a QBI loss of $200,000. Well, there's no 199A deduction in year 1. Let's assume in year 2, there's QBI income of $1 million. For 199A purposes, the year 2 QBI of $1 million is netted against the year 1 QBI loss of $200,000, for which nets to $800,000. 20% of that is $160,000. So that would be your 199A deduction. In other words, the QBI loss in year 1 offsets QBI income in subsequent years. Mechanically, what happens if in a specific year some QBI activities are positive and some are negative? The negative QBI is allocated to the positive QBI activities in proportion to their positive QBI. Once the net QBI for the positive activities is determined, it's that net number which is compared to the limitations, such as the waste limitation and the depreciable property limitation.
Do I get to count the wages and depreciable property of my lost businesses?
Unfortunately not. A common question that we've gotten is, what about capital gains and losses? Are they QBI? Well, generally no. Capital gains and losses don't constitute QBI. What about 1231 gains? The 1231 asset is an asset that's used in a trader business and held for more than a year. What if I incur a 1231 gain during the year and it's a capital gain? Is that considered QBI? No. If the 1231 gain is treated as ordinary income, which sometimes happens if there's 1231 recapture, the 1231 gain treated as ordinary is considered QBI. Gain from the sale of a partnership interest is typically a capital gain. That would not be considered QBI, but to the extent there is hot asset recapture, which is ordinary, that would be considered QBI.
Steve, how do capital losses and net operating losses from years before 2018, when these new rules come into effect, affect taxable income, to see if you're below that magic $315,000 threshold you were referring to?
They're treated as they normally would be in terms of computing taxable income for purposes of 199A. The 199A rules are very favorable to REITs and publicly traded partnerships. 20% of REIT dividends and 20% of PTP income are eligible for the 199A deduction. The benefit is that there's no W-2 limitation and there's no depreciable basis limitation. So somebody could have $1 million of taxable income, and if all they're invested in is REITs, they'd be entitled to the 199A deduction on the REIT income. It wouldn't really, there is no taxable income limitation. What if the REIT income and PTP income is negative for the year? That loss is segregated from other QBI activity. If the combined amount is negative, there's no 199A deduction for the year for the combined REIT PTP activity. That loss carries forward to the subsequent year
and is used to offset future REIT and PTP income in determining the 199A deduction, but it's not used to offset QBI income from non-REIT, non-PTP activities.
So to be clear, if I have REIT dividends of $100 and I have losses from my publicly traded partnerships of $1,000, I'm going to have I won't get any benefit of the 20% deduction for the REIT dividends, but that $900 net combined loss won't affect anything I have related to other qualified businesses.
That's correct. It's segregated.
Trusts. There was concern when these rules came out in December that taxpayers could plan around the wage and QBIA limitations by dividing assets among multiple trusts. Under the proposed regs, 2 or more trusts will be aggregated and treated as a single trust. The concern was that the wage limitation, the QBI limitation, come in at about $157,000 of taxable income and are completely in place at $207,500 of taxable income. So someone could take assets and divide them among separate trusts to constantly be under those limitations. The proposed regs shoot this down. The proposed regs would aggregate the trust and treat them as a single trust, which would effectively combine the taxable income if the trusts have the same grantors and primary beneficiaries. And the principal purpose of creating the trust or adding more assets to the trust was the avoidance or the minimization of income tax, and a non-tax reason for doing it couldn't be shown. There's still a lot of unanswered questions in regards to 199A, and I will turn it over to Mike to discuss those.
Sure, thanks, Stephen. We've been highlighting a lot of these unanswered questions along the way through this presentation, but I want to summarize some of them again, and I'm not doing this for purposes of being critical of Congress or the IRS, although I can do that if you want. But I think it's more to point out that there's still a lot that we need to understand and that we need further guidance on in order to be able to really maximize the benefit of this deduction. And remember that the whole point of this deduction, and we've been going through all the mechanics and everything, the whole point of this deduction was to make individual taxpayers indifferent as to the form in which they conducted their business. The corporate tax rate was lowered to 21%. The idea was to create a deduction that would benefit non-corporate taxpayers and in a way that would make them indifferent to whether they organized as corporations, S-corps, sole proprietorships. So what do we have with these regulations in the way of unanswered questions that we haven't asked so far? One of the things that you have to understand is that the theme that seems to come through from these regulations is that the IRS doesn't really understand that an entity, like an LLC or a partnership, can conduct more than one trade or business. So a lot of the guidance seems to imply that there's a definitional test of whether something is a trade or business that is applied at the entity level. So what we're not sure about is how to interpret that. In some places they refer to line of business, some places they refer to separate trade or business. So it's clear that the IRS isn't quite sure how to handle it, but how would you handle an LLC, for example, that had multiple trades or businesses within it? Do you look at the LLC as a whole, or do you analyze each activity to determine whether or not it's a separate trade or business? To go beyond that, if it is a separate trade or business, does it have to have separate books and records? We raised the question before about the pharmacy that's not only dispensing pharmaceuticals to the patients who come in, but it's also selling gift cards and automotive supplies and toilet paper and cosmetics and all kinds of non-pharmaceutical items. So the question is, do they need to have separate books and records in order to demonstrate the separate business activity of the SSTB and the non-SSTB that are all housed within the same entity? One of the things that we don't know. We know that there's a lot of information reporting that's going to be going on. Members of an LLC, partners in a partnership, are going to need to know their allocable share of the wages, their allocable share of the QBI, their allocable share of the UBIA. And bear in mind that the rules in 199 Cap A are different than the general partnership allocation rules that we're used to. So the question is, how should these things be allocated? We have some initial guidance from the IRS on UBIA that says that it should be allocated the way depreciation is allocated, but that could be very different in different partnerships depending on things such as basis step-ups or book-ups of assets under a rather arcane provision known as 704C. How should wages be allocated? The guidance says that wages should be allocated the way the wages are allocated in determining taxable income, but for most partnerships, there is no separate allocation of wages, which all of that leads to questions of whether or not there's an opportunity for taxpayers to game the system, to try to allocate wages differently among the members of an LLC, depending upon who needs it. Is that something that you could put into an LLC agreement and then specially allocate among the members? So those are things that we're just not sure about. One of the key things that we're not sure of is whether real estate qualifies as a trade or business. Remember that we mentioned earlier that in order to be a trade or business, it has to be an activity that's entered into regularly and continuously. Well, if I own a triple net lease asset, I might not be doing anything at all. The rent checks may come to me automatically every month through a lockbox. So does that constitute a trade or business? The 199 Cap A regulations don't refer back to 469, so the real estate professional rules don't apply here, and the material participation tests don't apply here. So how do we know whether real estate is or is not a trade or business? A number of groups that have sent comment letters to the IRS on these regulations already have requested that the IRS simply come out with a statement that says that rental real estate is a trade or business solely for purposes of 199 Cap A, but we don't know if they're going to do that. You heard Steve and I talking before, can you aggregate rental real estate businesses? And we said, well, maybe if there's a centralized management company that provides services to all of the rental properties, then in effect you could aggregate all of them. But suppose that's not the case. Suppose each property has its own management. You know, could I in fact be able to aggregate that because I've got common ownership, you know, and they're similar services, even if they're geographically dispersed? You know, we talked a little bit about the de minimis exceptions, you know, and the question is whether or not that's a cliff, essentially, that once you're over that de minimis amount, the entire business is tainted, or whether we have the opportunity to treat those as two separate trades or businesses at that point. And if that's the case, why would you need the de minimis exception? I mean, if you think about it, if I could always treat them as separate trades or businesses, I wouldn't need a de minimis exception. On the other hand, the de minimis exception provides me the opportunity to get the 20% deduction on my SSTB income that I wouldn't be entitled to without the de minimis exception and I are treating them as separate trades or businesses. So there's a lot of unknowns and a lot of things that we're still waiting for guidance on. We're hopeful that when the comment period is over, which is not very long from now, the IRS will come out with final regs, and hopefully before the end of the year. So if there is any time to do any planning, we'll be able to do it. So what planning opportunities are out there? The question we get asked all the time is, well, why don't I just forget about the complexity of 199 Cap A and just make my business a C corporation, get the lower deduction? And for some businesses, that is the right answer. But for many others, particularly those with assets that are appreciating, getting those assets back out of a C corporation might be very difficult and might be tax costly down the road. And again, one of the things that we always like to point out is that even if sections of the tax code are deemed to be permanent, once Congress gets their hands on it, nothing is ever permanent. A couple of years ago, we talked with a lot of you about something called the tangible property regulations. And at the time, we told you that there was a provision that said that if you had audited financial statements, you could adopt an accounting policy that said that anything that you bought with an individual cost of up to $5,000, you could write off as a supply. Well, now that might not be such a good idea because you might want some of those assets, might need some of those assets to be counted in the UBIA to maximize the amount of the 199 Cap A deduction. So on the one hand, is it better off to just write them off right now and get an immediate write-off? Or is it better to increase the basis for UBIA and get the 199 Cap A deduction over a number of years? So that's one of the things that needs to be evaluated. Bob raised the question of should you buy equipment before year end? You can only do that if you are actually going to use it in the trade or business. But on the other hand, if I'm going to need that piece of equipment in a subsequent year, I might want to buy it before year end. But remember what Steve said, you have to actually have used it in the trade or business during that year. So you can't just buy it and let it sit around unutilized. You actually have to place it in service.
What about leasing money? Is that lease equipment?
I can lease equipment, but if I lease it and it's not treated as mine for tax purposes, it doesn't count as UBIA. If I treat it as a capital lease and I include it in my UBIA, all you're really talking about there is how you finance the purchase. One of the big things is that we need to talk about owner's compensation. The wages paid to an S-Corp shareholder or guaranteed payments paid to a partner are not considered qualified business income and are not eligible for the deduction. But on the other hand, they also reduce qualified business income and therefore reduce the amount of the deduction that you are going to get. So that's something that we need to talk about. It may not make sense for partners to take guaranteed payments, and there's probably an optimal amount of S-Corp wages because don't forget, you do need some of them for the deduction in order to have meet the wage limitation. Should you gift interest to family members? Absolutely, if gifting makes sense. You can create more taxpayers that way and essentially create more taxpayers who are under the threshold and therefore not have to worry about the wage or UBIA limitations. Can you set up multiple trusts? Steve told you about the Anti-Abuse Rule, and while that rule is in effect and does limit your ability to do it, we believe that you could still set up multiple trusts as long as they are for different beneficiaries and you actually have a real non-tax purpose for setting up those trusts. The benefit of that is that you get multiple 199 Cap A deductions and you also get multiple $10,000 state and local tax deduction caps as well. If you have an SSTB and your income is close to the threshold number, and you want to be able to get the deduction, are there things that you could do to get you down below, get your taxable income down below the threshold? One of the big ways that we've identified is setting up retirement plans. If you have the ability to do that, you can take substantial deductions for certain types of retirement plans, reduce your taxable income, reduce the QBI, get under the threshold, and also get the 20% deduction. One of the questions that comes up from time to time is, can I still crack and pack? Crack and pack was the idea that Steve talked about where the law firm might put its real estate that it operates in into a separate business and then rent it back. That doesn't work because of the overlapping ownership, because of the fact that all the income is generated from the SSTB. But if there are other tenants in the building, and you can get around the overlapping ownership rules, you might actually be able to do that and turn it into a piece of rental property if you can get down below the common ownership and common usage threshold. So there are still some opportunities to do that. Bob, there's probably a whole bunch of other things we could talk about, but I see we're getting a lot of questions, so I'm going to turn it back over to you.
We do have a lot of questions, Michael. In fact, one was just on what you were talking about and getting taxable income down by retirement plan contributions. One of our listeners is asking if those qualified retirement plan contributions also reduce QBI. We don't know. One of the things that we don't know is how things like qualified plan distributions, contributions, how health insurance for self-employed individuals, how
the SE tax deduction, for example, how any of those things are treated for purposes of QBI. Those don't appear to have been discussed yet by the IRS, but we can expect some kind of guidance, maybe even only in the form of instructions to the tax returns.
So this stuff is really complicated. We've gotten a lot of questions from our people. No surprise there, and we're going to go through as many as we can. A reminder that if we don't get to your question, please do not hesitate to contact us one-on-one to discuss the matter. Thank you, Mike. Thank you, Steve, for this informative discussion. Let's start with an easy question, or at least I think it's an easy question, if there is such a thing on this subject. Is an internal medical doctor entitled to the 20% deduction?
If the internal medical doctor has income below the threshold, they'll get the deduction. If their income is above the 415,000 threshold, or the half threshold for single individuals, then they won't get the deduction. On the other hand, if you've got an internist who doesn't actually see patients, then that goes back to my radiologist thing. So if the internist only consults with other doctors and never actually examines patients, there's a real laying on of hands definition for purposes of whether healthcare is an SSTB or not. You've actually got to be in direct contact with the patient in order for it to be an SSTB.
How about a lawyer with $500,000 of taxable income? Is he still eligible for the 199A deduction if he has $200,000 of taxable income from a trade or business, such as rental real estate?
If his taxable income is $500,000, he'd be subject to the wage and the depreciable basis limitation, and he'd have to compute that on the non-SSTB activity.
So the answer is maybe.
Yes.
Right. How about a real estate management firm that does accounting for an LLCs? The questionnaire didn't say what the LLC does, but presumably it's real estate. Will that qualify?
That's sort of an interesting question, and I guess it would turn on what accounting services are really being provided. I mean, if that company is simply keeping the books for the properties that it owns or manages on behalf of other people, it would seem as though that's part of the normal activity of a management firm, real estate management firm, and not really an accounting business. But on the other hand, it's possible that could be one of those situations where the de minimis rule comes into effect, or the rule that says that if the SSTB services are incidental to some other activity of the trade or business and there's no separate charge for it, then they would be entitled to treat it as being eligible. Interestingly enough, unlike the other definitions in the regs, the definition of accounting for SSTBs is defined by who's doing it, not what's done. So I guess if the people doing it are not accountants or enrolled agents or return preparers, then it would be fine. That's a long answer to a short question.
Question that just came in: do subchapter S owners add back their wages to determine QBI? I think the answer to that is no. What do you say?
There's again, this is one of those areas where you would think it's an easy answer and it's not. There is some discussion that QBI doesn't include reasonable compensation of S-Corp shareholders. So the question is, no, you don't take the number on the return and add that back. QBI is net of that, and the wages themselves are not QBI. But the question is, could the IRS come in and say, well, the wages aren't high enough, and therefore your QBI should be lower because your wages should have been higher?
If QBI is a loss of, let's say, $200,000, how is it reported for the year of the loss? I don't think we know the answer to that yet.
We're waiting for the forms to come out, but generally speaking, it's just going to be carried forward So if there's no separate form as similar to the one that we have for passive loss carry forwards, it'll just be carried forward on a statement. But it does need to be carried forward, because if you have positive QBI in subsequent years, that nets against it first.
We have a question here related to partnerships, and Michael, as I mentioned at the beginning, your involvement with the American Institute of Certified Public Accountants Partnership Taxation Committee. Would an allocation of wages in a partnership for the 199A deduction be subject to subchapter K, section 704, substantial economic effect test?
I love questions that get down. I love questions that get deep down into the weeds. So yeah, that's where I was headed before. And technically, it's not subject to the substantial economic effect test or the economic equivalency test, because it doesn't directly affect the computation of taxable income. It affects the computation of a deduction at the individual level. That being said, so think of it like tax credits, which also don't have and can't have substantial economic effect, but need to be allocated the way some other item that does have substantial economic effect is allocated. So we're thinking that this is something along the same lines. So no, it doesn't have to meet it on its own, but it may have to be related to something that does have to meet those tests. So for example, UBIA is supposed to be allocated the way depreciation is allocated, and the allocation of depreciation is subject to substantial economic effect or economic effect equivalency. The bigger issue that we've got, and one that we didn't identify or stress yet, but we can bring up here, is with respects to the new partnership audit rules. Now, that's too lengthy a topic to go into here, but one of the concerns that we have is that if a partnership is examined, the new centralized partnership audit rules say that the partnership is supposed to pay the tax and it can push it out, but it's only supposed to relate to partnership items. And the service is taking the position that, notwithstanding anything else, the allocation of wages and UBIA among partners for purposes of 199 Cap A, even though it isn't in itself an item related to the computation of the taxable income of the partnership, is still a partnership item for purposes of the partnership audit regime. So there's going to be all kinds of corollary issues coming out of this as well. I would say that if you're in a partnership that doesn't have straightforward allocations, one of the things that you need to do is open up the agreement and talk about how these items are going to be allocated, and make sure that the allocations are at least reasonable.
Steve, I think you talked about the personal reputation as being part of the complexities as being part of the 199A deduction. We have a question: does a staffing company owned and built up with the reputation of its two owners qualify as qualified business income, qualify for the deduction? I would say the answer is yes, it does qualify, but what do you say?
I would agree. I don't think that would fall under the definition of an SSTB.
Okay, and how about interest income, Mike? Interest income, a business has interest on their working capital, charges interest on their accounts receivable, maybe is in the business of lending money. How is interest income treated as QBI?
Well, a business that's in the business of lending money, its interest is related to the trade or business, and therefore that interest income is QBI. For all other purposes, interest is not considered QBI. So even interest on working capital used in the business would not constitute QBI.
One of our listeners is asking how many, I assume the word is years, how many does the QBI loss carry over?
The QBI loss carries forward indefinitely until there's QBI income or 199 Cap A expires.
At the end of 2025.
Unless it expires earlier or unless it's made permanent.
Right.
the House did just pass a bill making it permanent. The Senate's indicated that they have no interest in taking up that bill now. They might after the election, but they certainly have no interest in taking up that bill now.
I know you touched on real estate, but we have a question. If a real estate professional owns 20 triple net lease buildings, is that considered a Section 162 trade or business?
I'd love to quote my cousin Vinny here and say that that's a trick question. but the simple answer is that the real estate professional test is irrelevant. And none of the 469 rules come into play with respect to 199 Cap A. And remember, we're not sure for real estate, first of all, if net leases count at all, or if the number of net lease properties is going to make a difference in terms of determining whether or not it's a trade or business. But if you had to read the regs and the statute right now, you'd be evaluating each of those as separate trades or businesses, and therefore none of them might qualify. So the number wouldn't matter. It's the nature of the activity itself. But the real estate professional rules don't apply here.
There are a lot of great questions. We're not going to be able to get to all of them, but here's one I particularly like. Would the 199A deduction affect basis?
No, it is not.
It's not.
Yeah, it's a non-basis item. One of the things to note is that the deduction is at the individual level. So ultimately, the partnership or the LLC or the S Corp isn't taking the deduction. It's the individual shareholders or members or partners who are taking the deduction.
So I want to thank you both again. This concludes our presentation. Keep in mind, if we didn't get to your question, we had a lot of them, please contact your Friedman advisor or email us and we'll try to get to it and help you out. Thank you all for attending. Have a good day.